Good morning and welcome to your daily market update for Friday, June 27, 2025. This is your complete, uninterrupted deep dive into the financial markets, economics, investor sentiment, and macro developments shaping the day ahead. Whether you're trading, investing, or simply staying informed, this extended broadcast gives you everything you need to understand where we are and where we might be headed. So, let's begin. As we open the final trading day of the week, U.S. equity markets are holding near record highs. The SPDR S&P 500 ETF Trust, commonly referred to as SPY, is trading at $611.87, showing a moderate gain of 0.74% from the previous close. Invesco's QQQ ETF, which tracks the Nasdaq 100, is also advancing, currently sitting at $546.22, up 0.89%. The Dow Jones Industrial Average has pushed to new highs, the S&P 500 is within points of its all-time closing high, and the Nasdaq continues its remarkable year-to-date climb on the back of tech strength and AI-related optimism. Small-cap stocks also saw renewed interest, with the Russell 2000 up over 1.7% in Thursday's session, reflecting broader market participation after weeks of mega-cap leadership. What's fueling this rally? One of the primary drivers has been renewed expectations for Federal Reserve policy easing. This has been supercharged by the latest political pressure on Federal Reserve Chair Jerome Powell. President Trump, during his campaign events, hinted at possibly replacing Powell before his term ends, claiming the Fed was too slow in adjusting interest rates to reflect economic realities. Whether or not this will materialize is uncertain, but the market interpreted it as a clear sign that monetary policy may pivot more dovish sooner than expected. Fed funds futures now reflect a roughly 65% probability of at least one rate cut by September and are pricing in more than 125 basis points of cuts through 2026. This shift in expectations has reverberated across asset classes. U.S. Treasury yields have dropped sharply this week. The 10-year yield now hovers around 4.24%, while the 2-year sits at 3.71%, reflecting growing conviction in a slower economy and looser financial conditions on the horizon. This flattening yield curve has provided significant support for interest rate-sensitive sectors, particularly technology, real estate, and consumer discretionary. Meanwhile, the U.S. dollar has weakened substantially. The dollar index is down nearly 10% year-to-date, marking its worst 6-month performance since 1973. As capital flows out of the dollar, it is finding its way into commodities, emerging market assets, and high-yield corporate credit. Gold, in particular, has been a standout beneficiary. Prices have surged past $3,500 per ounce, setting a new all-time high as investors seek both inflation hedges and protection from currency debasement. Oil prices remain elevated but contained. WTI crude is trading in the $65 to $67 per barrel range. The recent ceasefire between Israel and Iran has calmed fears of supply disruptions through the Strait of Hormuz. However, geopolitical risks remain elevated. Iran's parliament recently approved a symbolic measure to close the strait to Western ships, and although enforcement has not yet occurred, investors remain on edge. If conflict were to escalate again, oil could spike sharply, with analysts projecting a short-term range of $90 to $120 per barrel in the event of a disruption. Geopolitical risk isn't the only looming uncertainty. The U.S.-China trade truce, brokered earlier this year, is set to expire on July 9. If no agreement is reached or if new tariffs are imposed, particularly on semiconductors or rare earth exports, global supply chains could face renewed pressure. Industrials and materials companies are already factoring this risk into earnings guidance. Large manufacturers like Boeing, Caterpillar, and 3M have all warned of trade-related margin compression should tariff escalation resume. Despite these risks, corporate earnings remain largely supportive. This week, Enphase Energy jumped 12.8% on better-than-expected results, aided by an extension of solar tax credits. Freeport McMoran gained 6.9%, reflecting strong demand for copper. Meanwhile, JP Morgan Chase is nearing an $800 billion market cap, boosted by better-than-expected net interest income and a strong consumer banking outlook. These earnings have reassured investors that the fundamental backdrop, at least for now, remains healthy. On the other hand, some pockets of weakness are emerging. Equinix fell nearly 10% after missing its forward guidance. FICO slipped over 4% despite announcing a major BNPL partnership with Visa, as investors questioned whether the consumer credit cycle is nearing its peak. And while retail stocks have recovered somewhat, Many analysts expect pain in the consumer discretionary space if student loan repayments resume in the fall. Turning to Europe, equities are also performing well. Germany's DAX and France's CAC 40 have rebounded from May's pullback, helped by euro weakness and falling energy prices. However, UK retailers continue to struggle. Consumer confidence has declined for 9 consecutive months, and persistent inflation in food and utilities has dampened household spending. The Bank of England is expected to raise rates one more time in October, putting further pressure on the economy. In Asia, the picture is mixed. Japan's Nikkei is surging again, benefiting from tech sector exposure and yen weakness, while South Korea's Kospi dipped on disappointing export data. China remains under a cloud of deflation fears, real estate malaise, and tech sector regulatory overhangs. However, reports of a new $700 billion stimulus program have buoyed sentiment temporarily. Emerging markets are enjoying capital inflows driven by yield differentials and weakening dollar dynamics. The Indian rupee is holding near 86 to the dollar thanks to intervention by the Reserve Bank of India, while Brazil and Indonesia are seeing renewed interest in their sovereign bond markets. Investor sentiment continues to be cautious but constructive. The VIX, also known as the fear gauge, remains subdued at around 12.6, near its lowest point in over a year. However, options activity shows elevated open interest in contracts for mid-July, likely tied to tariff and geopolitical hedges. Institutional investors are positioning for potential volatility, while retail traders continue to chase AI-related momentum stocks. Speaking of AI, Nvidia remains the poster child of this trend. Its market cap has swelled to over $3.06 trillion, cementing its place as the second most valuable company in the world. Other beneficiaries include Supermicro Computer, AMD, Broadcom, and Palantir, all of which have seen massive inflows from both retail and institutional investors. While some warn that valuations are stretched, bulls argue that the AI revolution is still in its early innings. Today's economic calendar is light but important. At 10:00 a.m. Eastern, we'll get the May reading of personal income and outlays, which includes the Fed's preferred inflation gauge, the core PCE index. Later, the University of Michigan's final consumer sentiment index for June will provide insight into the spending mood of the American household. Analysts expect a slight uptick, but inflation concerns and interest rate uncertainty could weigh on the outlook. Looking ahead to next week, attention will shift to the second quarter earnings season. Major names like Nike, McDonald's, and Tesla will report. Analysts are particularly interested in margin trends and forward guidance as companies navigate a mix of slowing global demand and sticky input cost. What does this all mean for investors? The macro environment continues to evolve. The bullish case rests on continued disinflation, supportive earnings, and Fed flexibility. The bearish case centers on geopolitical re-escalation, trade disruption, and valuation fatigue. As always, diversification and risk management are key. Tactically, many portfolio managers are recommending a barbell approach, exposure to mega-cap tech on one end, and defensive sectors like utilities, healthcare, and consumer staples on the other. Gold and short-duration treasuries are being used as volatility buffers. Meanwhile, commodity-focused hedge funds are quietly increasing their allocations to copper, lithium, and uranium, anticipating a rebound in global infrastructure and clean energy investment. From a technical standpoint, the S&P 500 is facing resistance near 6,145. A breakout could trigger a move towards 6,200, while failure to hold support at 6,080 might lead to a short-term pullback. Nasdaq's breakout remains intact, though RSI readings suggest temporary overbought conditions. In the crypto market, Bitcoin is consolidating near $63,000, with bulls targeting $70,000 as the next major level. Ethereum is holding steady near $3,500, while altcoins like Solana and Chainlink are gaining institutional traction. Regulatory clarity from the SEC has improved sentiment, although the full legislative framework is still pending in Congress. That brings us to the close of the 6-cent daily market update. We've covered everything from the S&P 500 and the Federal Reserve to gold, oil, earnings, geopolitics, and global sentiment. Markets are resilient but far from risk-free. As we head into the weekend, stay informed, stay nimble, and don't let short-term noise distract you from your long-term goals. Thanks for tuning into this long-form update. I'll see you again Monday with your next daily market briefing.